All right.
Okay, hello everyone. Welcome to Legacy Wednesday, Financial Independence Through Real Estate. We welcome you all to our webinar today. We have a lot of people here. We have a lot of people registered, of course. A lot of people are joining in. So we're very excited to see the interest and willingness to learn. And of course, we're here to educate and help you all. If you're a physician or a busy professional like myself, and you're interested in securing your investment and pretty much trying to find how you could start, this webinar is pretty much for you. And our core team at Hedwig Capital hosts these webinars every Wednesday. So it's either 2 p.m. or 5 p.m. Central Time. And we come up with different topics to educate people about, and also educate them about different investment opportunities. The topic of our webinar today is stressful shifts to lifetime of cash flow. Next slide, please. The flow of our webinar today will go from the importance of passive cash flow, the challenges of healthcare professionals, aligning goals with multifamily investing, and the benefits of multifamily investing. Next slide, please. Going over a quick disclaimer, this webinar is for education purposes only and should not be considered as legal or an investment advice. The information in this webinar does not represent an offer to sell or solicit or solicitation of an offer to purchase an investment or securities. We highly recommend you all to involve your attorney, financial advisor, or CPA if you choose to if you choose to invest in any opportunity, and to educate yourself and do your own due diligence as well. Next slide, please. So going over a little bit talking a little bit about FIRE. FIRE stands for Financial Independence, Retire Early. FIRE is actually a big movement in the financial space right now. It's financial independence and the ability to retire early, primarily for professionals who've actually built some momentum in their career. And as fortunately, a lot of physicians already, are very well compensated from the very beginning. And they feel that they do have the leverage or the opportunity to be financially independent very early on in their career. However, that requires them to make very safe or very secure and very well thought of investment opportunities to be able to do so. What does FIRE mean? FIRE means pretty much the ability to retire at your own terms, to be able to work till retirement. If you would like to work till your retirement, it should be a choice rather than a need. And to not basically have a retirement age goal. You should be able to make your work a choice, and you should be able to guarantee a future for yourself and be able to live the secure lifestyle that you have envisioned for yourself without compromising it in future once you're not working. Next slide, please. So telling you all a little bit about Hedwig Capital. Hedwig Capital was founded by my husband, Sid Shamim, who's the founder and CEO, and myself back in 2017. Initially, we came up with Hedwig Capital with our main goal at that time was pretty much to have a safe platform to secure our own investment and to preserve our own wealth. Prior to coming up with Hedwig Capital, we actually, my husband primarily was doing single family real estate. We actually had a pretty sizable portfolio. At one time, we had about 30 houses, but we felt that this, managing single family houses pretty much at that time was not allowing us to build the momentum that we had envisioned for ourselves. We were putting in a lot of work with very little gain, and that led us to kind of think wide, and we kind of jumped into commercial real estate at that point. Since then, we have grown remarkably. Over the past 8 years, we have accumulated about 1,000 investors who are a part of our team. And of course, a very important member of our team is Brian Alfaro, who's in this webinar today. And I'd like Brian to introduce himself as well.
Awesome. Thanks, Anam. Really appreciate the opportunity to speak with so many savvy investors that are joining us tonight that are interested in the FIRE movement, financial independence, retire early. So as Anam mentioned, I am the Director of Investor Relations here at Headway Capital. Really excited to present this type of information and education to so many people and so many investors. I have a passion for sharing that information because, like a lot of people on this call, I didn't know anything about real estate many, many years ago. I don't come from a real estate background. My family didn't own a lot of real estate, and I didn't really know where to get started. So in 2018, I started investing just like Sid and Anam in residential real estate, single family houses, accumulated a small portfolio, and then very quickly realized that if I truly wanted to build generational wealth and to really generate cash flow for myself without trading time for money, because real estate can very quickly become a job. You can be buying a job if you're not careful. Buying a single family house can be like buying a job. That I needed to get into the commercial space. I needed to get in the commercial game, and I needed to work with more experienced partners and experienced operators because I knew I couldn't do it all on myself. I was a busy professional as well. So 2020, right around the time, right before COVID hit, I transitioned over from residential real estate, single family homes, over to commercial real estate. Spent some time at a boutique private equity firm, working on investor relations, talking to investors, spreading the knowledge and passion for real estate that I have. And I transitioned over to Headway earlier this year, and I couldn't be more excited about what we have in store for the future. But appreciate the introduction, and
Thank you so much, Brian. Next slide, please. So a little bit about our track record at Headway Capital. We currently have about 539 million worth of assets under management, and about a little bit of over 3,300 units under management. Over the past 8 years, we have averaged a prep return of 7 to 8% to our investors, and of course, a way higher cumulative annual return of about 25% once the final sale is made. So this is what our track record has been, and we're very, very proud of our portfolio so far. And of course, we have about Brian, let's say about 1,000 investors who work with us, right?
Yep.
So talking a little bit about our secret sauce at Headway Capital, we definitely have to say that I think our sauce for success is that we are very, very focused. We we make very sort of well thought of choices when we are very diligent about the assets that we choose and the offerings that we provide to our investors. We we are very purposeful. We are very disciplined at our work. We, of course, most of our residents at our apartments are our workforce clients, and they always didn't have a great space to live, but we make sure to provide them a very comfortable and great living space, while at the same time we make sure that they're paying their rents on time, that everybody is getting paid, including you and us. So that's we have a core team of about 50 people who work day and night to make this happen for us. And of course, we are very, very consistent, and we produce great results because of this consistency primarily. Next slide, please. So talking a little bit about the challenges of healthcare professionals. I feel like that's where most of my time is spent here at Headway Capital. My goal here is for our company is primarily I spend a lot of time actually talking to physicians, and a lot of my time is spent educating physicians and trying to basically figure out why a lot of physicians are so hesitant about investing. Now, being a physician myself and talking to multiple colleagues over the years, I have realized that physicians are particularly hesitant to start their investment journey. Now, a few of those reasons that I think are to be mentioned here are primarily lack of knowledge. Now, nobody in residency or even fellowship really educated me about coding, even let alone about investment opportunities, about how to invest your money in medical school. So lack of knowledge, I feel like, is a big limitation in the physician world. Physicians do not have much experience or knowledge about investing, and a lot of them absolutely do not feel comfortable in their ability to make sound investment decisions for themselves. Many physicians do not feel equipped that they have equipped to have enough information to make informed investment choices. We of course have a lot of time constraints. We work long hours, we have demanding schedules. This leaves us with very limited time to devote to investing. We, usually end up prioritizing our medical practice, prioritizing our our patients and their care over actually, you know, very little time is actually left to pay attention to our personal investment goals. So that definitely is a huge limitation. And we're also very risk averse. Physicians, due to just the nature of our profession, we healthcare providers are trained to prioritize patient safety to avoid unnecessary risk. And this mindset does translate into our personal investment choices as well. We tend to avoid making investments that we perceive are too risky, and primarily this perception is because of lack of knowledge. We have a fear of losing money. Most of us have dedicated years and years to medical training. And finally, when we're at a safe space to make money, we're actually very, very fearful of losing our footing. A lot of us have a lot of student loan debts. Many of us graduate with uh, hundreds of thousands of dollars in student loan debt, and we don't want to be in an uncomfortable space by losing money through risky investments, which we think are risky. We definitely have a lot of trust issues as well. Physicians definitely do not, I don't think they trust investment professionals or medical advisors as much, because a lot of times, what I've heard from other colleagues is that they feel that other people are there to trying to get their money because they do make a lot of money. So I think there's definitely is a lot of hesitance to trust others with their own finances, and physicians a lot of times end up trusting themselves to make sound financial decisions for themselves. So I overall feel that this hesitance to invest due to a combination of lack of knowledge, time constraints, risk aversion, fear of losing money, all these trust issues that we have, we end up, leaving a lot of our savings, a lot of our money in our bank accounts, and this is all our money is of course exposed to our market inflation, and it devalues over time. We Most of us rely on maxing out a 401k. Little do we know that this 401k is also exposed to market instability, of course, and it may not be enough money for us to continue a comfortable lifestyle that we have envisioned for ourselves once we actually decide to retire. So that definitely I feel like is a big limitation for us. Definitely, in this time constraint plus the burnout and fatigue we feel, it leaves us with very little time to think about other things outside of our medical profession. And I think a lot of my colleagues actually, whatever that time they have left, a lot of them end up taking more work shifts. So that's something that's a common thing that I've heard or I've seen around me as well. Next slide, please. So what is the importance of passive income investing? Passive income pretty much helps you to it 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 allows you to stop trading your time for money. So you can it allows you to have another alternate income stream source. Your money or your savings are making you more money, and that allows you to maybe take that hour break during the day to go have lunch with your son, for instance, or your children in their school, or take an extra week of vacation if you would feel like, or just take half a day off and just go out with your family. This definitely passive income allows you to offload yourself, to feel liberated to make these choices for yourself. And allows you to have more work-life balance as well. It allows you to move towards financial independence, allows you to feel less so dependent on your job early on, dependent on your job to make you money. And I think that really allows you to enjoy what you're doing as well. I think a lot of medical professionals feel burnt out because they almost feel that they have to meet certain numbers or certain thresholds. But once you have the mindset that you're financially independent, that really helps to offset that thought process as well. And of course, as we talked, it helps you have a secure retirement plan for yourself, and continue the same lifestyle that you built for yourself, as well as for your family and loved ones. So that definitely, I think, is really important to understand. Next slide, please. So aligning goals with multifamily investment, we mostly talked about this earlier on, but I think primarily financial independence, work-life balance, and retirement security would be the three I think top benefits of multifamily investing, and ultimately leads to much less stress in life and the ability to enjoy what you're doing. Next slide, please. Next slide, please. So I'll have Brian take over from here. He'll talk a little bit about the benefits of multifamily investing, as well as what we offer at Headway Capital here.
Awesome. Thanks, Anam. Just great job. Great information. I am not a physician, obviously, but hearing from somebody who is in the mindset that you think about, that you have every day, the hesitation you have with investing in what we call alternative assets outside of the stock market, outside of your 401k, outside of any numbers and letter programs that you're offered as a healthcare professional, it's really intriguing because, you know, we all come from different walks of life and we're all risk adverse to different degrees. So hearing from a physician and really getting in your mind, so to speak, on what concerns you have, allow us to better educate our potential investors and our investing partners. And whether you decide to invest with us at Headway or not, that's okay. We're here to share our knowledge and share our education with you. And hopefully this makes you a savvier, smarter investor. So I want to dive a little bit into multifamily. Anam talked about a lot of the challenges that you might go through as a healthcare professional, the stuff you're thinking about every day. And we want to talk a little bit about how multifamily in particular, and if you're not familiar with the term, multifamily is the industry term for apartments, apartment complexes. So those big apartments you drive by when you're going down the road, whether they're 5 units, 10 units, or 100 units, or 500 units, those are multifamily. It's apartments. I want to talk about some of the benefits you get investing in multifamily and how they can align with some of the things that Nam talked about, diversifying your portfolio, really getting back some of that time that you seek. So let's start with talking about steady cash flow and how does multifamily generate steady cash flow and how can that benefit you? So multifamily apartments collect rent. It's as simple as that, right? There's income. We have units that we rent and we collect rent from what we call residents. Some people call them tenants. We like to call them residents because that's their home. It's not just a unit. So we collect income from them. Now we have expenses. Of course, there are things we have to pay for. On top of our mortgage, we've got landscaping, we've got property managers, we've got water bill, electricity bill, we've got insurance. There's things that we have to pay for. There's expenses. When it's all said and done, we have profit. We have net operating income, right? We have other expenses that get covered at the below the line, but then we have profit, and that profit is shared with our investors that invest with us at Headway Capital. So you get that cash flow, steady monthly cash flow. So every month we're collecting rent from our residents. We're paying all of our bills. We're making sure all of our vendors are paid. We're making sure all of our employees are paid. And at the end of the month, there's profit left over, and our profit is shared with all of our investors, and we pay our monthly distributions. So you get that steady cash flow, usually monthly, but we also sometimes do quarterly. It just depends on the project. But the good news is if you're looking for cash flow, multifamily can be a great asset to generate cash flow. We'll talk a little bit about some of the challenges maybe later that we're facing in the market now. You might have questions about interest rates. I did see a question come in about how interest rates are impacting multifamily in the question box, but we'll talk a little bit more about that. But there is cash flow and there's an opportunity for cash flow is really what you're looking for. The next thing I want to make sure I talk about is cash preservation and upside. So medical professionals, healthcare professionals, as Anam mentioned, especially if you've been in your career for some time, you might have a large pool of cash. It's not uncommon that somebody might have very large six figures, if not seven figures, just sitting in a bank account, not doing anything, losing value, especially with inflation. Well, what's really important when you invest in real estate is that you think about the preservation of capital. You're parking your cash in a hard asset. It's a physical asset. It's a tangible asset. You can go and drive by and you can touch it and you can see it. So it helps preserve your cash. Now, can real estate go down in value? Absolutely. Are there risks involved with real estate? Absolutely. There's nothing's foolproof, nothing's 100% risk free, right? But it's a great asset that is disconnected from Wall Street, disconnected from the equities market to help you preserve your cash. Real estate typically doesn't move as fast as you see the S&P 500 and some of these other index funds and ETFs and things of that nature. It's a little bit of a slower moving beast. And it's also cyclical, just like the markets. But it does provide you the option to invest in an alternative that is not directly correlated with Wall Street, which is a great thing. We all know what happened in 2008 when we went through the great financial crisis. I was younger at the time. I was in college, actually, but I remember hearing stories of people who were nearing retirement and who were at retirement who got absolutely wiped out because their 401k dropped 30%, 40%. Just like that, right? So imagine being a healthcare professional making really great money and all your eggs are in one basket. You've got all your money in the stock market or some form of it through the 401k or an IRA. Those are all equities, right? And then all of a sudden there's some sort of market correction and your money just disappears almost overnight. Imagine losing half your retirement funds or a large chunk of it just like that, just because there's some bad headlines. We go through recession, GDP is down. So cash preservation and diversification, which is where I'm going here with that in a second, that's really important. But I also want to talk about the upside, right? So multifamily and real estate in general has upside, which is, in my opinion, if you are already a very highly paid professional, if you're a healthcare professional, you're making great money. Well, the cash flow is nice. It's kind of like the cherry on top, but it's probably not making a huge lifestyle difference at first. It can over time. If you're investing passively as a real estate investor over a 5, 10, 15, 20-year period, you're going to have substantial cash flow coming in as long as you continue to invest. At first, it might not make a huge difference, right? If you're investing for the very first time in a multifamily deal, let's say you put $100,000 in, let's say it has a 7% cash on cash return, which just means that your annual cash flow is 7%. Well, 7% of $100,000 is $7,000. That's spread out over 12 months, 7,000 divided by 12. It's like $600 or $700 a month. If you're making hundreds of $1,000s a year, that's probably not changing your life. Now, as its snowball gets to build and your 100,000 becomes 200 and your 200 becomes 400 and your 400 becomes 800 and you're constantly investing that cash, that's where it builds. But to me, where the real wealth is created is in the upside. That's the appreciation of the asset over time. These are 5-year projects. So they, even though we're going through kind of a down cycle right now, real estate goes down and then it goes back up, just like everything else. It's very cyclical, right? So it's not about necessarily timing the market. It's about time in the market. And you want to catch that upside, right? You want to make sure you're investing at a time. To me, I actually think it's a great time to invest because property values are down and everybody's freaking out. And I'm like, don't you want to invest when everything's on sale, right? It just makes more sense that way. So you want to catch that upside, right? You want that equity appreciation. And in commercial real estate and multifamily in particular, we're actually able to force upside. We're actually able to force appreciation, which is beautiful because we can buy an asset that is not ran very well, that has not been taken care of. We can improve the quality of living for the residents that want to stay. We can get rid of the ones that don't want to stay and that are causing a bunch of trouble. We can renovate and make the property a much more beautiful place to live. And we can ultimately increase the income. Well, multifamily is valued based on its income. It's its income divided by cap rate. That's how the properties are valued. So the cap rate is something that we have no control over. That's what the market dictates. It typically doesn't move very fast. The cap rates are, kind of within a range. But the NOI we can impact. We can improve the income by charging what the market rent should be. If market rent is supposed to be $1,000, but we buy it and it's at 700, well, that's beautiful because we have a lot of room to improve there, right? So we actually get to force appreciation, a force upside, which is really where you catch that 25, 30% average annualized return is by catching that upside. The cash flow is kind of like the cherry on top to me. So moving on, just the last thing before we move on to the next slide is talking about the importance of portfolio diversification. I spent a little bit of time just talking about that a second ago, but I think it's really important for everybody to understand how important it is to diversify. Nobody wants to have all their eggs in one basket. As I just mentioned, things like 2008 happen. You never know when something's going to go down. I would tell somebody the same way. I love real estate. It's my favorite investment vehicle, but I would never tell somebody to put all their money in real estate. It's just, again, diversification is really, really important. And there's diversification actually within real estate as well, right? So, within multifamily, there's diversification. You can invest in different markets. You can have some multifamily in Dallas, some in Houston, some in Phoenix, some in South Carolina. You can invest in different markets. That's diversification. You can invest in different asset classes within multifamily. You can say, hey, I want to invest in this value add opportunity, which just means it's a little bit more distressed. It's probably bought at a lower price point. It probably has more meat on the bone, which means it's probably a not very nice property, and there's a lot of opportunity to renovate. Well, those are more risky, so they have more rewards, meaning they produce better cash flow over after the renovations, and they have more upsides. So that would be what we call like workforce housing or a C-class property. But you can also diversify. Maybe you invest in a C-class property, and then you also invest in an A-class property. Well, what's an A-class property? An A-class property is going to be a newer property. That's going to be something built, say, 2010 and up, something at least 10 to no more than 10 to 15 years old. It's going to be in a great, probably an A class market as well. Great schools, great shopping, great retail, newer homes around it. More affluent demographics as well. People that have higher average household incomes, right? So if you're diversifying within the multifamily umbrella, you can have some A-class assets, you can have some B-class assets, you can have some C-class assets, and you can have different markets that you invest in with different operators, right? So there's diversification within real estate, but really the main point here is it's really important that if you have all your eggs in one basket and you're on this call, you're listening to this, you really want to consider diversification, because everything is good until it isn't. Right. And ask somebody who was investing in 2007, who felt like they were on top of the world, in 2008, slapped them off the mountain. And we might be going through one of those opportunities here now, where we're starting to see some changes in the market. We've been seeing changes in the market. We're seeing about rising interest rates. We're seeing about properties going down in value and supply and demand within residential real estate and commercial real estate. There's a lot of things going on, and we at Headway are very opportunistic. We want to take advantage of opportunities when the market gives it to us. So even though it might be challenging to find a great deal right now, we want to still go out there and go look for them, because they're out there. There's going to be people who need to sell. So these are some of the benefits of multifamily, and how do we take advantage of these at Headway? Moving on to the next slide, what type of opportunities do we provide to our investors to be opportunistic, so that you can take advantage of generating cash flow, of diversifying your portfolio, of getting that equity upside? The one thing that we love, as mentioned already, are apartments. We love multifamily real estate. If you have not invested with us and you're not one of our a large pool of investors that have invested with us since we've been around in 2017. I would encourage you to sign up for our private investor club. We'll have some information at that at the end, but we love multifamily. We love apartments. As Anam mentioned, we own a property management company here in Houston, Texas called Headway Properties. We have 50 amazing partners that work for us and that go in every day and work their butt off to make sure that our residents are super happy, our properties are very well taken care of, our lenders are very happy, and then ultimately our investors are very happy, right? So apartments are one of the asset classes we're very bullish on, no matter what's going on in the market, because people need a place to live and housing is no longer affordable. So we love multifamily. Service businesses, we often look for real estate businesses we can either attach to our portfolio or acquire and layer onto our portfolio to provide benefits to our investors. We have a construction company that we have in-house as well at Headway Properties, so that we can go in there and renovate units on our own. We own a roofing company as well, so we can provide services to ourselves at a discount. There's a lot of things that we try to do to provide value to our investors. Real estate debt fund. I'll talk about that one last. Let's talk about car washes. So car washes are something as well that we offer to our investors throughout the year. Very bullish on car washes. Why do we like car washes? They're a little different than multifamily, but also similar. Car washes are great because, one, they provide a diversification piece. I mentioned a minute ago, don't put all your eggs in multifamily. Don't put all your eggs in one thing. This is a diversification within the Headway brand. Two, they provide what's called monthly reoccurring revenue, MRR, just like tenants pay rent or residents pay rent in your multifamily apartments. Well, car washes, their bread and butter are selling memberships. They want to sell you a membership when you drive up to get your car washed, which if you've been through a car wash in any recent fashion in your area, you've probably been offered a membership at some point. So selling those monthly reoccurring memberships provide a great opportunity for reoccurring revenue, which allows us to pass that on to our investors through monthly cash flow distributions. So we're very bullish on car washes. We have a portfolio of car washes in the Carolinas. We've been investing in car washes now for about a year and a half, and we're looking for opportunities as well here in the Texas market. So very exciting stuff. And the last thing I just want to touch real quick about is the real estate debt fund. If you are interested in generating passive income, you like monthly cash flow, the debt fund is for you. So our real estate debt fund is something we recently launched. We're about to open it up for investment later this week. We announced it on a webinar last week, but it's essentially a hard money debt fund. So if you're not familiar with what that is, essentially we partner with investors like you. We take your capital and we put it to work with other investors that flip houses, fix and flip houses, do rental properties. We provide them short-term hard money loans. We charge them a high interest rate. We keep the difference and we pass that capital onto our investors. So this is a great opportunity. If you've got money sitting on the sidelines, you don't want to invest in a CD, you want to invest in something that has some liquidity, and you really like real estate, you want to diversify into real estate. We offer a couple of different options. It has a $25,000 minimum. If you invest $25,000, it provides a 6% return, preferred return. That's from $25,000 all the way up to $99,000. If you invest $100,000 or more, it provides an 8% preferred return. There's no equity upside. There's no tax benefits. Like, we didn't really talk about taxes today, as there are in multifamily. It's just straight monthly mailbox money, monthly cash flow, and you can actually choose to compound it. So if you don't want the monthly cash flow and you just want to put your money to work, you can let it ride, as I like to say. You can let it compound, and over time it will continue to grow. So it's a great opportunity. If you're looking for a place to park your cash and you want some liquidity, there's a 90-day liquidity window. So you can pull your money out anytime. You get it back within 90 days or less. Scan this QR code or reach out to us afterwards, and we're happy to talk more about the Headway Debt Fund. Again, this is about to launch later this week, and we've got tons of investors already signed up that are excited to get in. So don't miss out. Last couple of things before we dive into Q&A. Lots of questions and answers, questions coming in. If you want to begin your investing journey with us at Headway, you do need to schedule a consultation call with us. Our investor list is a private list. It's not shared with anybody. You do have to speak to a member of our team to get on the list. That's because we want to make sure we are a good fit for you and you are a good fit for us. It's important that we have alignment, that you understand what we're working on, and that we understand what your needs are. We want to talk to all of our investors and have a relationship with them to understand exactly what your problems are and how we can do our best to find opportunities that solve your problems. Whether you're looking for cash flow, you're looking for equity upside, you're looking for tax benefits, you make too much money and you're looking for somewhere to park your money because you need tax benefits. We need to know those things so we can go out and find those opportunities for our investors. So schedule a call, scan that QR code to schedule a call. I believe that link takes you to a call with me. So you'll get to schedule a call with me. And of course, if you schedule a call with us, we got a treat for you. We've got a physician's guide to passive income that I'll share with you as well if you schedule a call with me and connect. So looking forward to that. And now, without further ado, I've got quite a few questions and answers coming in. If you have any questions, please put them in the Q&A box. We are going to go through as many as we possibly can. We're excited that so many people are interested in going through these. So I'll go ahead and just start knocking these out before you get started. Would you recommend investing in single-family homes before becoming a passive investor in commercial? That's a great question. I would not. So it's really preference. I get this question a lot. A lot of people say, hey, I want to get into real estate. Should I go into residential real estate first? The question I like to ask them is, how much time do you have? Because if you don't have a lot of time, residential real estate is very time consuming. I still love residential real estate. I'm not somebody who just like kind of craps on it all day. I think it's a great asset class. It's a low barrier to entry. You put 20% down on a $200,000 house, you drop 40K. And it starts cash flowing pretty immediately if you're buying the right house, right? So, but it's, again, as I mentioned, you're talking about $200 or $300 a month. If you're already making a substantial income, it's not going to change your life. And it's limited on the upside by its comps. Unlike multifamily, which is valued based on its income, residential real estate is valued based on its comp. So if you don't have a lot of time, you don't have a lot of experience in real estate, and you want to work with partners, I would recommend you go straight into passive investing as a commercial real estate investor. It's going to save you a lot of headaches, and it's going to save you a lot of heartaches, and it's going to save you potentially a lot of money because everybody thinks they're super smart until they get into the game, and then they realize it's much harder than it looks. Nobody likes taking phone calls at 3 a.m. because a toilet's backed up. You probably don't like chasing residents for rent every month when they call you and tell you their story about why they can't pay their rent on time. There's a lot of things that we deal with on the property management side that protect you from those types of headaches. So I would definitely encourage you, if you've got the money to invest, I would encourage you just to jump right into the passive commercial real estate side. It's going to provide you a little bit more time freedom.
I think, Brian, just to add on that, I think Sid and I, we also had like, we used to spend a lot of time between our tenants when there would be a switch.
Mm-hmm.
So that really, I feel like that offsets you a lot as well, because, the time that your property is vacant, or if it's not, or, you're renovating it, that really offsets whatever profit that you're making throughout the year as well. So I think that was something that we felt we went through.
That's a great point, Nam. So for anybody who's not familiar, maybe you don't own any real estate, what Nam is alluding to is what we call vacancy, meaning there's somebody not there, right? And in residential real estate, if somebody moves out of your house, it's empty. You make $0. Right. In multifamily, we're buying 100 units at a time. If 1 or 5 or 10 people move out, well, that's not great. We want to fill those units up, but you're still making money, right?
Right.
Right.
And then also the ability to have a team managing your properties, because even if you have a single family portfolio and you hire a third party company to manage you're giving a big cut of your potential profit to that third party, which ultimately really offsets all of what you think that you would make, but you don't make that much. so
Absolutely.
Definitely that was something we experienced.
Absolutely.
Okay, moving on to the next question. I think they asked this, how do I sign up to invest? So we've already shared the QR code. Can we go, you could just scan this code here, but definitely use that, and that will take you to set up a call with Brian. So,
Yep.
And then you can sign up from there.
Perfect. Yeah.
Okay, so our next question is, do you think cash flow is more important than equity upside?
It's a personal preference. So I'd love to hear your response, Nam. I'll tell you what mine is. I'm at a point in life where I really like cash flow. I don't like to invest in things that don't cash flow personally. It feels good when you hit that, you open your phone and you get that email that says you made $1,000, you made $500, right, whatever it is, right? I like to invest in things that have cash flow. Now, if I was a physician on top of the world making $500,000 a year, and $500 a month probably wouldn't get me super excited. So I think it depends on where you're at in life. A lot of people are already generating a lot of cash flow. Maybe you're a very seasoned investor and you don't need the cash flow. And if that's the case, well, then you should be looking for things that have a lot of equity upside, right? But if you're, say, maybe a little bit younger in your career, you're in your 30s, 40s, still got plenty of runway to work, no reason to retire early necessarily, or at least go to 65, then you should be looking for equity upside as well, because that's really what's going to help you build the wealth snowball. But what are you thinking, Nam?
I agree with you. I also think that, the cash flow helps you to kind of continue diversifying your portfolio even more. So the more you make, you can, kind of invest into different options. So I would agree with you. I definitely think that for me as well. And I mean, physicians, if you're talking about the physician on top of the world, I don't think physicians make as much as they used to maybe 20, 30 years ago. So definitely most of us and most of the people that I talk to definitely are interested in seeing the cash flowing into their account, and that also gives them a lot of security about their investment and making
Right.
sure that it's a good one that they've jumped into. So
right,
for
and
sure,
I think a big part too is retirement, right? Yeah, physicians,
right.
healthcare professionals typically make a good healthy living, right?
Right.
And typically think about a 30 or 40-year career as a healthcare professional. You probably have a pretty nice house, a pretty nice car. You love vacations. You're not necessarily living lavishly, but you enjoy the nicer things in life.
Right.
Well, nobody wants to give those up when they retire, right? So in order to keep those, what do you need? Cash flow, right? So again, I'm a cash flow fanatic, but that's just me.
Right. Okay. So moving to our next question. My time is scarce. How much work do I have to do after investing? Well, If your time is scarce, there's a lot. I mean, I think I can talk a little bit about it. I think when we started, of course, we're actively managing a lot of things, so there's a lot of work involved. But once, I think the main thing with this process is educating yourself, finding a team that you trust, finding group of people or investment opportunity that you have faith in. And once you invest, there's actually not a lot of work that needs to be done. I mean, we regularly send all the financials to all our investors. I mean, it would be really good to know what these financials mean, to go over them, sit down once a month at least, and make sure that your money is secure. But I think, I don't know, more than that, most of our investors, I don't think, have to spend a lot of time in their investments. And it's, of course, you're making more money. What do you think, Brian?
Yeah,
Think
no, 100%. I mean, part of the reason we do what we do is we're providing you an opportunity to invest without having to spend a lot of time. So
right,
I would agree with Anam. She said something really smart. If you didn't pick up on this, I'm going to highlight it again. There is homework involved on the front. You don't
right,
want to just throw your money at somebody you just met. You want to do your homework. You want to check not only the property. I think people spend too much time focusing on the deal, like what's the building, what's the asset, how much cash do I make, but ask about the partners, ask about the sponsor, ask about the person who you're
right.
giving money to. What's their background? How much money have they managed before? What's their track record? What's their success? Have they had any failures? And if they have, that's okay. Are they honest about it? Are they transparent about it? How do they overcome them? How do they learn from them? So there's homework involved in the relationship, as I like to say. It's kind of like you meet somebody, you want to hold hands before you date, before you get married, right? And
Right.
once you wire that money, you're kind of married, right? These are 5-year deals. But so you want to make sure you go through that process, that sort of holding hand and dating process, to make sure you understand that there's an alignment there. But you're right. Once you actually invest, there's a reason it's called passive investing. You're going to get monthly updates from us via email, and maybe you spend 15 30 minutes a
Right.
month just kind of looking at the updates, looking at the financials. And as long as there's not an issue, there's not really a big reason for you to spend any more time on it. We do webinar updates once a quarter or semi-annually. We'll get a big webinar. We'll say, all of our investors come attend this webinar. We're just going to give you a video update of everything going on. It takes 30 minutes. It's optional. If things are going great and you don't care, you're getting your money, you don't have to attend. Or if you're just curious, you can. But there's not a lot of time involved. So if you're scarce, this is a great opportunity for you.
Yeah, and then we all have an open door policy. So if there's, at any point you feel that, you haven't paid a lot of attention to your investment, you just want to get an update, so you can just hop on a call. We're there for you. We can answer all your questions, um, walk through your properties, see how things are going. So definitely we offer a lot of flexibility and a lot of, I would say, transparency there. So that's for sure. So yeah, I agree. There's not a lot of time that's involved. Okay, so the next question is, what is the difference between debt fund and multifamily?
Oh, that's a great question. So the debt fund, I talked about it a little bit. The debt fund is it's a fund, so it's not a particular asset. So the difference between a fund and an asset, so like a multifamily deal, we launch those deals. We try to come out with 2 to 4 multifamily investments a year. So one a quarter is really our goal. Obviously, things are a little challenging right now, so it's harder to find a great deal, but you're investing in one particular asset. So if you're on our private investor list, private investor club, and I send you a deal and I say, hey, Anam, we've got this great multifamily opportunity coming up. Would you like to invest? Here's all the information you need to make a decision. You're investing in that one particular asset. It's going to be at 1234 Main Street. It's in this city. It's in the zip code. It's this many units. We're paying this much. Here's everything you need to know about it, right? The debt fund is not like that. You're not investing in one particular asset. You're actually investing in all the loans that get made from the hard money company. So we have aligned and partnered with a hard money company that loans out money to people who fix and flip houses. So you're getting diversification where it's not, if you invest $100,000 in a multifamily deal, your money goes all into that one deal, right? All into that multifamily deal. So it's kind of sink or swim. If that deal tanks for some reason, your money is at risk, right? Well, in the debt fund, it's actually diversified. So if you invest $100,000 in the debt fund, then your money is being pooled into with everybody else's money. And just for reference, just so you guys know, there's about $30 million in the debt fund as we speak today, right? So your money goes into that pool, and everybody's money gets chopped up in little pieces and spread out across the amount of loans being made. And at any given point, there's anywhere from 10 to 20 loans in progress or in flight, as we like to say. So your money's being diversified, and there's a little bit more risk diversification, I would say. Now, there's a give and a take to that, right? So multifamily, I'm making it sound like it's riskier. I would argue it's actually comparable, but there's differences in the sense that one, there's no upside. So the debt fund has no upside. It's just monthly cash flow. It's just mailbox money. It's like investing in a CD, right? You just get your cash flow. The multifamily deals, it's going to be cash flow plus your equity upside, plus you actually get some tax benefits as well. You get some depreciation that you get to use against your passive income, right? So you're making this passive income, and you get to take the depreciation that the asset generates and use it against your passive income. So it actually offsets a lot of the passive income that you make, not your active income as a physician or a healthcare professional, but your passive income. Well, you're not going to get that in the debt fund, right? It's just cash flow. So it's actually taxed as if it's active income as well. So again, give and take as far as what you're looking for. But those are the main differences. One, you're investing in a diversification fund, again, in single family hard money loans, or you're investing in a single asset for commercial real estate.
I think the other thing is that you're in a debt fund, your money is liquid, right? So, giving a 90-day notice, you do have the opportunity to take out your investment if that's not something that, or you end up with something you need in your money to, just, I guess, anything. Right. You could pull your money. In multifamily, it would be different. It would be a more long-term commitment, but a debt fund allows you. I think the way I see it is that rather than your money being devalued in a bank, I think this is a really good way to kind of, if you're not sure about exactly what multifamily asset you want to invest in, or you're, just parking your cash and having the flexibility to pull it whenever whenever you need it with a 90-day notice. So I think that's a big advantage of investing in a debt fund.
Agreed.
All right. Okay, so I think we're running short on time, but we're gonna take maybe 2 more questions. So let me kind of go over them and see. Okay. Okay, there's one question for me. So how do you balance being a full-time physician and investing? Mm-hmm. I think at this point in my life, and my work is my full-time job, of course, and that's what I do. But in my free time, I definitely feel that because I have more knowledge now, and I was lucky to be married to someone who was definitely way more financially savvy and educated than I was, and I've learned a lot through this process. I definitely feel very comfortable, and I enjoy learning more about investing, helping others invest, and it's I wouldn't say it's entirely a hobby, but it's something that adds more flavor to my life, less monotonous than doing stuff related to medicine. So I think I do invest quite some of my free time into thinking about different investment opportunities and talking to investors, and I enjoy it. So that's how I see it. And I definitely, once you get more educated, once you start making more money, I think you're going to have a very similar mindset as well.
Awesome. I'm going to take this last one. We got one final question, then we'll wrap up. This is a good one. So everybody who's hung around to the end. Before we present this last question, I do have a quick poll for everybody who's on here. So I'm just going to launch it real quick. So if you guys can answer that, if you're on your phone and answer that, that'd be great. If not, that's okay as well. I'm just curious if you've invested in real estate before, for all the people that have joined. But our last and final question of the night is, let's see where to go. Here we go. How are interest rates impacting multifamily investing right now? Are there still opportunities to invest? That is a great question. So everybody reads the headlines. We see the news about inflation. We see the news about the Fed raising interest rates. We see the news about potential supply and demand with residential housing, but how is it impacting commercial real estate? How is it impacting multifamily? Well, let me give you our side of the coin. First of all, I will say that since they've started raising interest rates in March of 2022, finding a great investment opportunity has been very challenging. It was already challenging beforehand due to the demand of multifamily. Multifamily has been the golden child of real estate for the last 5 years. Everybody wants to invest in multifamily. Maybe that's why you're here. You heard about how amazing it was, but that's made it very competitive. There were opportunities during 2019, 2020. Well, I'm sorry, 2020, 2021, 2022, where we were looking to buy a 20 or $30 million deal, and there were 30, 40, 50 people bidding on it. Right, this is insane, right? We're talking about a $30 million building that 50 people are trying to buy. So it made it very competitive. What did that do? That drove up prices. Well, prices got really high because interest rates were also very low. So you had this weird mix of high prices, low interest rate, cheap money. Money was cheap; it was easy to get. So it fueled this just ball of energy around this asset class, and everybody was trying to buy it. Well, it all popped in March of 2022, where interest rates started rising and the Fed got really aggressive. They've never raised interest rates this fast, right? So now we're sitting here today where the average mortgage for a single family house, this is for single family, is around 7.5 to 8%, right? Commercial real estate is going to be a little lower than that just because it's a different asset class. You're borrowing more money, but you're still in the high fives, low sixes, 6.5%. It's not crazy to see. Well, interest rates were 2.5, 3%, 3.5. Money is not cheap anymore, right? So what has happened to the pricing of multifamily? Well, surprisingly, it hasn't dropped as aggressively as I thought it would. Prices are still high compared to what we think the properties are worth. So we've got this what we call a buyer seller disconnect where we want to pay X and they want Y, and we're just not able to meet in the middle. So we're still seeing that on a daily basis. And then also debt is very expensive. We're very conservative when it comes to taking on debt here at Headway. We don't want to borrow 85, 90% leverage. That's too risky for our investors, too risky for us, too risky for me. So right now the banks are only lending out 55, 60, 65. If you have a really great deal, maybe you get 70% leverage, but we're seeing 60 to 65% sort of being the average amount of leverage you can get. So you have to bring a 35, 40% down payment. Not a bad thing because you're not overexposed with leverage, but it means it's much harder to close on because you have to raise more money. You need more investors to get that done, right? And the last and final thing that we've seen is because of prices being so high, money being so expensive, and we've actually seen rents finally come to a halt. I wouldn't say they're declining necessarily, but they were growing very rapidly coming out of COVID. In Houston alone, we saw 16% rent growth in 2021, which is crazy. They're finally flat. So you've got high prices, expensive money, expensive debt, and you've got flat rental income growth, right? So what does that mean? Well, you would think there would be no demand for multifamily. Well, it's not true. People are still looking for multifamily because they're still very bullish, but it's made cash flow very tight. So in order for us to find a deal that we're comfortable presenting to our investors is we have to find something that is distressed, and we have to find something that's at a severe, deep discount in order to make the numbers work, because finding cash flow has been very tight for multifamily, specifically the last 12 months, I would say. So our job and what we do here at Headway is to go out there and find those deals. We got to find those distressed. They could be on market, they could be off market. We got to be talking to brokers, and our job is to find an opportunity that can cash flow, because we don't want to present something to you that doesn't cash flow. So that's kind of what's going on in a nutshell. It's a very challenging market. Money is very expensive from the banks. It's hard to find a great deal. It's hard to find things that cash flow, but we are still very aggressive in a good way. We're looking for great deals, and we're going to be very opportunistic. So for everybody that got to join this call, hopefully you're excited about it as we are. We want to present you with great cash flow opportunities that are going to allow you to build cash flow, build your wealth, and hopefully reach that financial independence and retire early. Anam, any final words?
No, I think that would be I think we pretty much summarized it all. So I would just say that if you're interested, please sign up and schedule a call. So we look forward to talking to
Awesome.
you.
Thanks everyone for attending. Have a great
Thank
week.
you, everyone.
Yeah.